Good evening, everyone. This is Jonathan Pollard of Pollard Financial Coaching and Gen Y Financial Freedom coming to you this November 13th, 2014. And today's Daily Dollar is entitled 401ks, Roth IRAs, and IRAs. And I guess if you wanted to put an umbrella title over it, it would be tax advantaged accounts. So let's jump right in. A lot of people, in the financial media talk about the importance of saving for retirement, and that really can't be understated. In my last two videos, I spoke about life insurance, disability insurance, and protecting yourself to the downside. And the reason that these financial pundits talk about, saving for retirement is because retirement also, in a sense, protects you to the downside. Now, yeah, a lot of people want to invest, to send their children to college or to be able to buy, to be able to afford little luxuries or maybe even big luxuries. But the fundamental thing that you're saving for is retirement in terms of building wealth. You want to be able to stop working one day. You don't want to have to work all the rest of your life. And you might not even necessarily be able to work all of the rest of your life. So that's why saving for retirement is so paramount. Because saving for retirement is so paramount, the government has somewhat incentivized it by the creation of certain provisions in the United States tax code, in the Internal Revenue Code, the law that pertains to taxes, in order to help people, help the little guy, help the middle class consumer get ahead. So I'm going to discuss three of these primary tax advantaged accounts. And when I use the term 401k, I mean I use that term interchangeably with 403b because, and you'll see what both of those things are later, but they're essentially the same thing. It's just that one is with a private employer and a 403b is with a nonprofit employer. So let's jump right in. What is a 401k? A 401k plan is a tax advantaged savings plan, a retirement plan that's usually held with one's employer, where you can put away up to for 2015 $18,000, and if you're over 50, you can do an additional cash-up amount of $6,000, bringing the total amount of money that you can save per year from your salary up to $24,000. The same thing applies with a 403b plan. A 403b plan just is a tax advantage plan that is held by a nonprofit employer, right? So a school or a church, if they have retirement plans for their employees, they will have a 403b plan. Now I know these letters and numbers might sound a little bit weird. They just refer to the sections of the tax code that talk about them. Okay, so to continue on with the 401k plan, you can contribute a total amount of $18,000 from your paycheck into that 401k plan. However, you can't really withdraw that money until 59 and a half. The government's rationale is that they don't want people taking out that money prior to retirement. And when you put that money away, you're not being taxed on it, right? So let's say you make $100,000 a year and you are under 50, so you're not putting away that extra $6,000. You're just putting away the regular $18,000 that you are capable of putting away. If your income is $100,000, you are only taxed on $82,000 from your annual salary. And the reason for that is that the 401k is tax advantage, in that the money that you save for retirement is not taxed until you withdraw it at 59 and a half. If you withdraw the money prior to 59 and a half and it's not subject to certain exemptions, meaning that the government hasn't said that you can use it for certain purposes, then you will be hit with a 10% penalty, and you'll also be taxed at your current rate if you make a withdrawal. So it's very important that you don't make random withdrawals from your 401k plan. All right, that'll be very, very harmful to you financially. Okay. Another thing is that you are required to start making distributions from a 401k plan after a certain amount of time. I believe it's 70 and a half. The government doesn't want your money just sitting around tax deferred. It wants to get its cut, so it forces you to start taking money so it can take those taxes from it. All right. With regard to a Roth IRA is something that is also a tax advantage plan. You put the money that you put into a Roth IRA is after tax dollars, right? So whenever you pull that money out, you are not paying taxes on it. Now you can only pull it out. Well, theoretically, you're only supposed to pull money from a Roth IRA out at 59 and a half, but because it's after tax dollars, you can pull your contributions, any contributions that you've made to the Roth IRA out at any time. There is no time frame or time restriction on when you can pull out your money. However, you cannot pull out the gains. You cannot pull out more than $10,000 in gains prior to 59 and a half, unless you are either going back to school or looking to purchase a home. There are certain income restrictions to you and contribution restrictions on you when you're dealing with Roth IRAs. For one, you can only contribute up to $5,500 a year to a Roth IRA. And in order to be able to contribute, there are certain income restrictions that you must meet. For the Roth IRA for 2015, you have to make under $116,000 in order to qualify if you're filing taxes, if you're single or a single head of household. If you're married, filing jointly. If you make under $183,000 or less, then you're also eligible for a Roth IRA. However, if you're married and you're filing jointly and you make in between $183,001 and $193,000, you're only eligible to make partial payments to a Roth IRA. You can't contribute the full $5,500. If you are married filing separately, if you have any income over $999, then you are not eligible to contribute to a Roth IRA. So if you have income that's under $10,000, then you are. If you're married but filing taxes separately, okay. With a regular IRA, you can contribute the same $5,500 a year, and additionally, I didn't mention this when I was talking about the Roth IRA, but you can also add an additional $500 per year in catch-up contributions if you are older than 50 years old. There is no income restriction on having a regular IRA. If you have any sort of taxable income, you can contribute to a regular IRA. However, the IRA is somewhat different from the Roth IRA in that you're not contributing after-tax dollars to the IRA. You're contributing pre-tax dollars, right? So you're putting the money in and you're letting it grow, and then once you pull it out, then that's when the government taxes you. It's very similar to a 401k plan in that respect. The time, just like with the Roth IRA, the time that you can pull out money from a regular IRA is at 59 and a half, and if you do so before, then you get hit with penalties, a 10% tax penalty, a 10% penalty from the IRS, in addition to being taxed on the amount that you withdrew from the regular IRA. All right, and also IRA stands for individual retirement account. Just in case you guys didn't know that, I thought I'd throw that in there. With regard to a regular IRA, participants are required to start taking distributions at 70 and a half. If you do not start taking distributions at 70 and a half, then the government takes half of your required distribution. And once again, the reason is that the government wants to get its tax money. Right. With regard to a Roth IRA, you are not required to make any distributions even after 70 and a half. You can just let it grow on in perpetuity, and that's because the government has already gotten its grubby little hands on your money. Another thing that I wanted to point out to you guys is that I personally don't believe that with regard to a 401k that you should max it out. A lot of times you hear financial pundits saying, oh, you should max out your 401k. However, I disagree with that. I think that you should put enough money in a 401k plan, a tax deferred plan, in order to get your employer's match, because it's free money. All right. So if your employer matches 3% of whatever your total salary is, then you should contribute up to that 3% into your 401k, and then you should stash your other savings in a Roth IRA. You should max out your Roth IRA, and the reason for that is that 401k plans are very inflexible, in that they're very limited in their investment options. You can't just invest in a whole bunch of different stock that you think is good. You're constricted to whatever mutual fund plans or whatever stock plans that the company that you work for has. With a Roth IRA, you can put multiple assets in it. You can put real estate in it. You can choose your own stocks. You can choose mutual funds. You can choose index funds. But you can't really do that in a 401k plan or a 403b plan. So I think I said a mouthful here today, and I hope you guys all enjoyed. As always, if you have any questions, please feel free to email me at jcp182000 at yahoo.com. And thanks a lot, and I hope you guys stay tuned.